Howdy, folks. It is Dr. Jeff Camarda. My, oh my, it's been a long time since I've done this for you, and I'm giving you a weekly update based on notes prepared by Jonathan Camarda, our Chief Investment Officer, who is on the job, but having technical difficulties and not able to record video, at least to the degree of quality that you certainly certainly deserve, and hopefully will become increasingly used to. Anyway, so I'm going to try to translate Jonathan's very, very technical descriptions, and I'll give you an overview at the end. He says that under his direction, portfolios began to increase risk exposure after hedging into a down start of a week. When we say hedging, we mean changing positions in anticipation of changes in trends, not actually buying offsetting options and doing truly hedging in the technical or in the traditional sense. Continuing with his notes, began adding risk exposure during the Fed meeting as Powell softened his hawkish tone on how the Fed deals with slower growth data. Note that we started over a month and a half ago, and as we were entering recession upon energy collapse in June, and I just pat myself on the back. I called the recession probably about two and a half months ago. And I'll have some more comments on Powell and the future direction when I'm done with the notes. He mentions his propelled risk assets, tech, semiconductors, and treasuries, which is the Fed announcement, with decreasing rates on intermediate to long yield of the yield curve. And that's really an inverted yield curve, and that means that when near-term interest rates, short-term interest rates go up, and long-term interest rates go down, that's market feedback that this is going to be recessionary and signals that they expect the Fed to be lowering rates down the road in order to spur economic activity because in order to cure the recession. And again, that doesn't mean that's what's happening. That was just a market reaction to it based on the relative prices of short and longer term bonds. He also makes a note that in some of the portfolios were positioned, particularly those that are appropriate, positioned for Treasury price spike a couple of weeks ago, and then the board noted inversions along the yield curve before the meeting, which is. And with the gestalt of that is we anticipated this increase because of the inversion of the yield curve in longer term bonds, and they took a position there that I think paid off pretty well. Jonathan, again, these are Jonathan's notes, which I'm hopefully successfully translating a little bit, but we're increasingly conservative on an uptrend, is even with negative GDP for 2 quarters. I mean, that's really the classic definition of a recession. That the more dovish Fed will allow for riskier assets that have been hit hardest, like tech discretionary, to find some momentum. So basically, Jonathan is saying that the short-term trend, tech, rose, and some other stuff, and we're increasingly, I guess he said constructive, not conservative on it, but trying to take advantage of these shorter-term trends in order to buffet what we see as a long-term downtrend. And that he interprets, and I agree, that I'll talk about more in my comments, that Powell and the Fed only did a 3/4 point increase, and more importantly, his comments after, leaving the door open to interest rates, smaller interest rate increases or even reductions down the road, was kind of pandering, to the political environment and trying to keep the market from really imploding. And I think it's going to backfire, but I'll talk about that in a little bit. So although we're not overly optimistic, Jonathan says, yet this is the bottom. This is the first follow-through week after the Fed speech this year of upside versus rolling over post-Fed speech early in the year, which is Jonathan speak for saying that we had a really, really nice bear market rally here after the Fed announcements, which hasn't been the case for much of the year where the market reacted negatively to Powell's comments. And the last thing is we had a number of sales last week right before Powell's speech, and they were intended to be protective. And the technical explanation Jonathan gave is that the S&P 500 broke the 8 moving average, and the ADX momentum went negative after a July 22nd bearish engulfing pattern on high volume. Monday held with the Dow Jones above 8 moving average, a shaved exposure on bird. My goodness, my head is even starting to spin on broaching of 8 moving average information. Till this week, oblivious macro, cognizant Fed rhetoric, Powell minutes Wednesday. Okay, Jonathan, let me see if I can translate that. And boy, was it a mouthful. Basically, that although this bear market rally continued through last week, especially driven by Powell's comments, it's really just that. We still expect that we're going to see significant downturns from here. And you got folks, the important thing to remember is the context, not what happens day to day, but remember that, the definition of a downtrend or a bear market is lower lows and lower highs. They're still highs, but it's just trending lower, up and down, so up and down, up and down, up and down. The camera goes the other way, but you get the point. Nothing ever really goes straight down or straight up. And our overall perspective, mine and Jonathan's, is that we're still in a pretty vicious bear market. I don't think we've seen the bottom. We'll have rallies along the way. Inflation still, despite some good news on food and gasoline and so forth, is still vicious, high, stagflationary, it seems like. We probably are in a recession, and not just the United States. China's having incredible problems. The International Monetary Fund, I think, called the global recession as a very high risk a couple of months ago. And that's really been, underscored by the fact we've had 2 quarters now in a row of negative GDP growth. So hopefully that's not the case, but our expectation is that this bear trend will continue for an extended period, to use Fed speak, and that we better be careful and keep lots of dry powder, in order to maintain value. And back, to Powell speak, there's a lot of factors that play on Fed decisions. I hate to, put this back on him, but it was only a year and a half, not even ago, that, they said we're not going to raise interest rates because this, the inflation is temporary, it's transitory, it's going to evaporate. Well, it's actually exploded instead of just evaporated. And my expectation is that by not giving the economy the medicine it needs, which is accelerated rate hikes, which is going to cause a recession, and unemployment is going to get worse and a lot of other things, that we could be facing the sort of stagflationary period that the country endured twice, really, in the 70s. There's a really, really good article, I think, and maybe it was the Times, but I think it was the Wall Street Journal, comparing this period to inflationary period stretching back to the 1940s, driven by World War II and price controls and so forth. So anyway, I think that we are far from out of the woods, and our board, led by Chief Investment Officer Jonathan Camarda, is being very, very careful and looking to still make money along the way, but to be very careful and preserve value during this dark time. So you guys, Camarda clients at least, come out lots happier on the other end. And with that, is Dr. Jeff Camarda. Yes, I'm still here. This is, not some hologram of me from the grave. I expect to be around for quite a bit, and hopefully we'll spice up your video viewing pleasure with occasional snips from me. And now, back to Frankie, the video interrupter. Thank you so much. Talk to you soon. Bye-bye.